Welcome to another episode of the Tech and Real Estate Podcast. Today, I'm thrilled to be joined with Devon Kennard, a 9-year NFL veteran, entrepreneur, and real estate investor. Not only has Devon made an impact on the field, playing for teams like the Giants, Lions, and Cardinals, but he's also built an impressive real estate portfolio and continues to inspire others with his dedication to financial literacy. Devon is also a 2019 Walter Payton Man of the Year nominee, a family man, and someone who's showing that life after football can be even more impactful than the game itself. Today, we'll dive into Devon's journey from the NFL to real estate investing, his mindset around financial freedom, and how he balances it all. Let's get started. Hey, Devon, welcome to the show. Super excited to have you here.
Thanks for having me. It's a pleasure.
Yeah, we have a lot to discuss today from your background, your experience in real estate, financial literacy. Well, before we do, you actually have a really interesting and unique background with your prior career. So, can we dive a little bit into that and how you fell into real estate?
Yeah, so I just retired in 2023. So last year from the NFL, I played 9 years. I played for the New York Giants, Detroit Lions, and Arizona Cardinals. And then I have to mention I played for Baltimore, but it was like a quick little stint. Like I had a coffee there. I was there for like 6 or 7 weeks. So I kind of put that as a caveat. And I started investing as soon as I got into the NFL. It was something I realized. I was in a profession that you can make really good money in, but the average career length is 3.5 years. I was a fifth round draft pick, which for those who don't know, that's pretty late. There's 7 rounds in the NFL draft, and I was picked at the bottom of the fifth. So pretty late in the draft. There was no guarantee on how long I was going to be in the NFL. So I had the mindset of like, let me save as much money as I can and figure out what to invest in. And real estate felt like the best vehicle for me.
Incredible. There's so many folks who they may go into these dream jobs, right? Which yours, I think, even kind of times that times 10. But they're always looking at right now. They're spending, maybe even outside of their means or like right at that cusp. But you were thinking, even from a young age, how do I actually take my earnings and be able to have a full life with it? So, have you always been money conscious, or was this maybe a guide or mentor that you had?
Definitely a mentor, but not in the sense I can't say like I have had a mentor that's walked me through any process, but I've been inspired a lot and I listen to a lot of books and podcasts. So for me, one of my biggest inspirations was in college. I was a number one recruit out of high school for football, but I faced a lot of adversity in college. So where it didn't look like my NFL dreams were going to happen. So I started to network a lot, trying to figure out what I was going to do outside of football, and I sat down with the guy who was a police officer turned real estate investor. And he started out house hacking, which for those that don't know, that's buying a house and renting out a room or renting out a part of the house if you have like a basement with its own entrance, or maybe it's a duplex. So it's just finding a way to subsidize where you call home. And he started doing that and then did it to another house and stacked. And by the time I met him, he owned over 6,000 units and had his own property management firm with 10,000 units. And I remember distinctly leaving the meeting like, well, first of all, he had one of those moving desks that can go up and down. And that was the first time I saw one of those. And he was in what I would consider today like a Lululemon outfit and was just telling me about his lifestyle. And I'm like, you're living like that and you started off with a police officer salary. Like if you can do that, I want to go to work with a Lululemon outfit. So I'm like, if he could do it, then I can do it. Maybe real estate is the route for me. So that's where I started like reading the books and listening to the podcast and was like, okay, maybe real estate is the avenue that I can go down as well.
Got it. So you saw someone who's achieved great success with real estate, and they had a. I love the part that you mentioned the standing desk because actually, like pre 2020, those were really expensive. So he was definitely doing well, and you wanted to see how can I maybe get knowledge in this space and emulate this for my own life. Now you had a really demanding career where most must have taken most of your time. Where did you fit the space to be able to learn about real estate?
So this is, I have a strong opinion on this because if you are online and in the real estate space, even if you're a beginner starting to follow all the people who are on Instagram, YouTube talking about real estate, a lot of it is like active, how to fix and flip homes and how to like, be full time in real estate. But for me, I love my full-time job and I wanted to maximize that to the best of my ability. And I like the stability of a job and the 401k and the retirement plan. So like the idea of like leaving my job and taking on real estate full time was out of the question. So it was the conversation of like, I either figure out how to invest passively with the limited amount of time that I did have, or I don't invest at all. And for me, not investing at all wasn't an option. So it was like, how can I get into real estate, how to figure it out. And there were kind of three vehicles that I talk about in my book coming out that really stuck out to me, and that was building my own portfolio of properties, that was investing in syndications, and then becoming a private lender myself with the excess capital I had. And I kind of found that those three vehicles specifically, you can really build out a portfolio within real estate and do really well for yourself.
Excellent. So you mapped out all the options, thought if I'm going to do this, it has to be passive. So you already like solidified what the avenue would be. And then you start to do the research in those particular areas. So now tell me how you start to begin to scale, where you're actually maybe applying some of these learnings that you've had.
Well, yeah. So I think you got to kind of start out with knowing how much time you have. So for me, I kind of really qualified. Like when I'm in football season, I had about 5 hours a week, and that was it. Like 5 hours where I can give concentrated effort. I would spend like sometimes if I'm lifting weights, I would have headphones in listening to an audio book. So I would kind of like steal time a little bit like that. But concentrated effort, I only had about 5 hours a week. So with single family and smaller multifamily investing, I had to figure out what that would look like with just that limited time. So there was two solutions that I kind of came to, and one was turnkey providers. So that's working with essentially people who are fix and flipping properties at scale, most likely, or maybe they're builders and they're selling to investors a finished product for the most part, and allowing you to buy the properties, and they're connecting you with property management, or have property management in house to where it's pretty much like the idea of turnkey is like you buy the property, you turn the key, and it's working for you. But you have to understand the pros and cons of that. It's extremely passive, but they're getting the extra equity from the property this way because they're the ones that bought the property. Let's say it's $100,000. They bought it for $50,000. They're putting $30,000 into it, and they're selling it to me for $100,000. They're capturing that $20,000 spread, and I have to be okay with that, understanding that I'm not getting a lot of that extra equity, but all right, it's a cash flowing asset. And then I have to believe in the location that it's going to appreciate over time and it's going to cash flow better over time. So that was the first way and how I started out. And truth be told, that's a little harder today than it was when I started out in 2014 because properties don't cash flow as well. So you might have to put more down, or you might have to figure out a way to make it cash flow a little better because things aren't cash flowing as well. So that would shift a little bit in today's market. But when I was first buying, that's how I started. And then the second way is you start to build out what a lot of people call your core four team. So that's finding your deal finder on the ground, that's finding a contractor and a property manager, and the fourth one is a lender. And if you can build those four people out, like your deal finder being most important, what I found is if you find a deal finder, it's kind of like the domino effect. Like they can connect you with a good contractor and they can connect you with a good property manager. So once I started to build that out, it was like, how can I find rock star deal finders who are going to help me find that $100,000 property that's $50,000, connect me with a contractor who can renovate it for 30. And then now, instead of spending $100,000 on that property, I spent $80,000, and I captured that $20,000 equity. I'm renting it out. Now my return is better. So those are kind of the two ways that I like seeked throughout my career. And I started out with turnkey because it was a little more passive. I got it under my belt, and then I started wanting to capture the equity and building out my team. And to be honest, I think the building out the team and all that is where you and what you guys have built can really be helpful, because the systems, putting that in place, figuring that out, that's the biggest challenge with that component. And like, how do I build out the right systems and have the right software behind me to where I can systemize that whole process? And for me, I didn't have you and what you guys provide, so I was kind of figuring that out and what tools can I use? So I use Deal Check and Stessa. I don't know if you've heard of either, but those are two platforms and applications that I've used to help me keep track and organized, and and stay on top of my portfolio of properties.
Oh, yes, both those platforms are excellent. And I absolutely love the progression of your real estate journey because a lot of folks that I meet that are newbies, they just want to, jump 10 levels and go straight into like their first burr, but they have limited time. And you set the stage of having discipline, which, everyone's listening to this, listen to that back. Only 5 hours of time that Devon had a week, and he still made it work by being laser focused. And then the next stage, like you said, going to turnkey providers because you still recognize that you are still in a learning phase and you have limited time. But now, once you got comfortable, you started to build your own team, which I love. And were you initially apprehensive of building a team, or do you think because you've always been in a team environment, it was just natural that there needs to be different people with different skills to plug into your workflow?
Yeah, well, to start, I want to kind of point out that it is okay with getting some base hits, especially early on. Like some people want doubles, triples, and home runs, and aren't excited if it's not that. But I'm here to tell you, the base hits like are great plays. My first ever property was $87,000 in Beech Grove, Indiana, and to be honest with you, that base hit turned into a home run when I held it long enough. And what I mean by that is I put $12,000 down with a partner, and 5 years later I had cash flow that whole time, and then 5 years later we sold it, and I we each pocketed $25,000. So I got 100% return just on the sale, not including cash flow. So the dollar amount wasn't anything that was changing my life, but the actual return on my investment was extremely high, and that was considered a base hit when I first bought it. So I want to point that out to your listeners, because I think that's a really important factor, to where it might not look like a great play at first, but I am so glad I bought that first property. It turned out into a great deal, but even if it was just an average deal, what I learned through that process was instrumental, and it kind of got me along the way. So I think that's a huge lesson. And then to kind of answer your question with taking on and building out a team, I think it grew with my comfortability. So I started buying some turnkey. I understood, all right, the team was pretty much given to me, but I started to see who I needed on a team. Well, who did these turnkey providers have? Well, they had people finding them the deals, they had contractors, and they had property management in place. Well, how can I build that same thing? And what does it look like? What am I looking for? So you start to ask a lot of questions. What's the average price for a property manager? I found that it's 8 to 10%. I say 8 to 10, but to be honest, every property manager I work with charges 8. So my kind of standard is 8%. And you start to like learn those kind of things and really understand, and the people you work with, they have a reason to want to do good by you, to where if they see that you might be buying multiple deals, they don't want to recommend a contractor that does bad work. So now you're incentivizing them to give you the best recommendations, because they want to build a relationship with you and see you as somebody that they can work with long term. So make sure that every relationship you have is mutually beneficial. You want to pay people well, but not have to overpay, and they need to look at you and be like, oh, I can give him a fair price and he's going to keep on coming back to me. So I really kind of emphasize the relationship with every person I have on my team, to where they want to be fair to me and I'm fair to them, and we can build something to where we're going to work together long term.
I think that's an amazing point, right? It's not just selecting the individual who's going to do the job for the least amount of work. That sometimes you don't incentivize the person the right way by doing that, and you want to make sure it's mutually beneficial. So, with that, I do get a lot of questions from the audience where they ask, if I'm building a team, where do I start? I understand that rock stars know rock stars, but should I start by talking to agents, to contractors, property managers? Do you have any suggestions for them?
The reason why I call like the first person on your team the deal finder is they can look a lot of different ways. So it could be an agent, it can be a wholesaler, it can be another investor. I found deals from all three. So I say kind of try to reach out to all three. You don't discriminate, but you want a rock star in the sense of they have worked with investors a lot. So if it's an agent, it's very popular nowadays for agents to say investor friendly. If they've never seen a pro forma or don't know what they're looking at, if you send them, the deal check, it gives you a deck, a PDF, and if you send that to them and they don't know what they're looking at, they're not, they're not investor friendly. So you got to kind of weed through that. And same with wholesalers. Like, are they sending you properties that are pretty much just on the MLS or MLS value? Like that's not that hard to do. Are they actually doing real work and finding distressed properties, and they're getting their fee, whatever their fee is, but they're still selling it to you for under market value? So understanding and evaluating that, and then do they have the relationships? You can't tell me you're finding off market deals or you have good deal flow, but you don't know good contractors, you don't know good property managers, you don't have lending recommendations that they close deals with the kind of properties that you send to your clients. So I think it weeds itself out if you know how to ask the right questions and you're very specific with, okay, what makes you the right fit for me? And I think starting to help, using them to help you build a buy box. So make sure you're transparent with how much capital you have to invest, what you're looking for. Are you someone who wants higher cash flow? Are you okay with more appreciation? And as long as it's paying for itself, and being transparent in that. Because if your listeners are mostly working professionals, a big thing for me is I didn't want to work with a deal finder and then they start flooding my inbox with 100 deals, because what I found is I'm not going to review all those. So it's like in football, we say, if you see a little, you see a lot. If you see a lot, you see nothing. And what that means is, like, send me 5 deals. And if you send me 5 deals, I can see a lot, because I'll be able to really go through those deals in the time that I have and be like, I like this one, I like that one. If I see a lot and you're sending me 100 deals, I see nothing, because it's like I get overwhelmed. I might peek at a deal, then get sidetracked, look at another, and I get nothing. So I always talk with my deal finders on, like, let's funnel this down and help me build a buy box that fits my needs and is within what you can find for me. And good ones will help you do that, and they will be kind of the linchpin to your whole team.
Completely agree. I love that methodology, starting with a deal finder, having a bit of your buy box ahead of time so that you can kind of determine, like, are they able to really curate the best deals for you? And then from there, you can ask additional questions about contractors, lenders, and so on. And naturally, they should be able to answer that. So, with that, Devon, I would expect that your buy box has actually changed over time. So, what does your buy box look like today? Are you still in the same markets or looking at the same properties?
No, I'm not in the same markets. My first ever property was in Beech Grove, Indiana, from a turnkey provider. He ghosted me because he had an institutional buyer that started buying up all his properties. So I bought one and never bought again in Indiana. So that made me move to Ohio, and I invested there for a while, but I had issues with the city. They were like, they started giving investors a tough time with lead-based paint in their houses, and remedying it with city contractors that were upcharging like $2,000 or something per property. It was getting outrageous. I was getting upset, and I didn't like visiting Ohio to go check out my properties, so I got out of Ohio. So the main markets I'm in now is actually your market in Tampa, Phoenix, Arizona, and then I own properties in Kansas City, but I've also been looking at Dallas. I want one cheaper market, because Arizona and Tampa are both kind of pricier, more appreciation generally markets. So I'm trying to decide what market will be my cash flow market moving forward. I might stay in Kansas City, but I've been seeing a lot of deal opportunities in the Dallas, outside of Dallas, in some suburbs that are is growing a lot. So those are 3 markets. And then within that, in your market, I really like the St. Pete and Dunedin areas. So I look heavily in those markets. And then in Arizona, I stay close, within like 30 miles from where I live, because my wife and I self manage right now. So that's kind of a rule of thumb. And I want to be in a it's more of an appreciation market, so I have to really believe in the neighborhood, and it has to be within 30 minutes of where we live. That's a huge kind of marker for me, and we're just kind of always looking in that market.
Excellent. Again, love how laser focused you are and the reasoning behind each of these markets that you're focused and interested in. And you said that you self-manage. So curious to know, do you use particular softwares to help you self-manage that you would recommend to others?
On our personal properties, we only manage in Arizona, and we have an Airbnb, and then we have one rental property, and we like Appfolio, but for just two properties in Arizona, we don't like. We typically just use Stessa right now. All my other property managers in Florida, in Tennessee, even when I was in Ohio, in Beach Grove, Indiana, it was always Appfolio. For me, it's my preference to work with property managers, and I think whenever we have a robust system, we may use that, but there's probably cheaper options. So, we'll kind of play that by ear as we grow. I don't know if we start scaling substantially in Arizona, I don't know if we'll actually self manage at that point. Right now, it's just two properties. We have cleaners for our Airbnb, so it's like 15 minutes away. We'll go pop our heads in. It's been pretty low maintenance. And then our long-term rental, it's like tenants call us if there's an issue, but for the most part, it's just my wife is an agent here, so she comes up with the lease agreement. We have our standards, so it's more leasing than anything else. So it's been manageable, and I just keep track of it on Stessa, which I love. But I think I'll have to reevaluate once we get over 5 units in Arizona.
Yeah, it makes complete sense. Love that you have a well-oiled machine going. It's mostly hands-off, and you've done an amazing job, Devon, in really scaling your portfolio, learning about real estate. And now I'd love to segment over into finance. So, a big part of your background is also sharing financial literacy. So, what are maybe some drawbacks that folks may not realize how real estate can help them? And how do you try to kind of uncover that in either your book or potentially some of your prior videos?
Yeah. So one of the biggest things I kind of talk to people about is understanding the spread in your life. And for me, the spread is like how much you make versus how much you spend. And that difference in between is the spread. And how do you maximize that spread? And, I think it's an extremely important thing to consider. And with that, a lot of people focus on what they're spending, right? Like you always hear about cutting Starbucks, cutting Netflix. And I'm not saying those things aren't impactful, but I think people are ignoring the real expenses that need to be addressed, and that's your fixed expenses. And let's talk primarily your housing and transportation. People are, you start to make a little bit of money. You're in tech. You're a professional athlete. First thing you do is go get a pretty expensive home, and you forget all the expenses that come with that. You're probably not doing your own lawn. You might have a pool, depending on where you live. So now you got maintenance, the electricity on a $5,000 house versus a 5,000 square foot house versus a 2,500 square foot house is double. So all of the expenses with your housing, the insurance is more, the taxes is more. So there's a lot that goes with the decision you make on your housing. And same with the car. The first thing you start to do well financially, and instead of driving the Toyota, you go and get the Mercedes. And so those decisions and those choices, it's making your fixed expenses a lot more expensive, and those impacts that spread more than the leisure, what I call variable expenses. Like, I like sneakers. Buying a pair of sneakers every now and then and paying $150, like, yes, I could cut that back, but that's actually less impactful than me choosing to live somewhere where my mortgage is $4,000 as a comparison to 2,500. That's $1,500 difference a month. Times that by 12, you start to see the compounding effect, not including the bills that come along with it. So you're talking about spending 15, 20, 30, $40,000 more a month or a year based on where you live and the car and cars you decide to drive. So I really emphasize, pay attention to that and try to make frugal decisions in those areas, especially early on and as you're building out. And even now, I didn't max out where I can live. We live modestly to where our fixed expenses are fairly low, and I think that is a huge plus to living comfortably, and something that people need to address. And then the flip side with how much you make, I think a lot of people, don't take into account of like making sure you're increasing your earning potential to the best of your ability by adding skill sets to yourself. I've had to learn this in football. Like, you everybody is replaceable, and they're trying to replace me constantly in football. So I need to be adding skill sets to myself, so to make myself more valuable. I found that a lot of people in the workspace, they forget this aspect because it's not as much in your face. It's not instant. Like in football, I'll see them working out somebody in my position that they're hoping is going to take my spot. You might not see that in a tech job, for instance. So you forget that part of it. But don't be mistaken. They're trying to replace you with somebody cheaper, faster, smarter, or maybe it's technology. So, like, can they replace your job with technology? So when you keep that in mind, you're always trying to add value to yourself to make yourself indisposable. And I think people need to focus on that so they can continue to increase their earning potential. And that's going to increase your spread more and more. So I think that is the biggest impact, because that spread is what allows you to invest, which allows you to start to earn more passive income, grow your net worth, and make it so you get to a place where you're working because you want to, not because you have to. And that, I think, is the ultimate, should be the ultimate goal, to where you're living life on your terms. Maybe you love your job, but now you're generating $10,000 a month in passive income. You're staying at your job because you want to, and you like it, not because, like, I gotta pay the bills.
Incredible wealth of information, Devon. And I love the way you laid it out, the spread aspect, multiple streams of income, and then being able to have that build up enough where you can choose to work or choose to work on what type of projects that you want. And one thing that I want to highlight too is that that spread that you mentioned of your expenses and your income, that affects all levels, right? So it's not just for the person who's at a high income earner, but also the person who may be on the other end of it too. I've seen a lot of times that someone continues to get, a new job or could progress in their career, but for some reason they're always struggling with money because even as their income goes up, their expenses go up. So would you agree that it's also across different incomes, not just for high earners?
Oh, 100%. I think it affects everyone because, whether you're making a lot of money or a little bit of money, it's like it's the spread between that really matters. And if you're always increasing how much you spend to what you're making, then you never get ahead. So what you should do is kind of set a standard of living that you're comfortable but not excessive, and then keep on pressing up what your earning potential is. If you can keep that here and then you're continually earning more, that spread is increasing. What a lot of people said, to your point, even if you're not a high earner, maybe your spread is here, you start making more, you start spending more, and you're never able to increase that spread enough to make an impact in your financial life and to build wealth for yourself. So I think that it's important, and it doesn't matter what range you're in on your income level, it affects everybody.
Definitely. And Devon, how do you actually get this mental fortitude to be able to tell yourself, I'm not going to spend as much? I would imagine that when you were, in the gym and there's probably a guy next to you with a chain that was three times, or jewelry at the price of everyone else that was there. So how do you tell yourself, I'm not going to try to overspend and be similar to someone else next to me? I'm okay with being frugal. How do you get that mindset?
I have a different perspective on this as well, because I feel like I've been exposed to a lot of people with money and who live like that. And it's like, you like what you like I mentioned, I really like sneakers. There's a dream car that I've always wanted, a certain level of a house that I've wanted. So I'm not trying to tell people that they can't have things that they want at some point. The key is delayed gratification and making sure you're making intentional decisions with that. Like for me, my dream car was always a Range Rover. I always wanted to buy a Range Rover one day. But when I first got in the NFL, guess what? I brought my high school car out. It's just me. I didn't need it. And I only changed cars eventually because I was having issues in New York and it was old. So then I worked a deal with the dealership and drove a free Kia for three more years, partnering with the dealership. And I would get made fun of, like, oh, you're in the NFL, why are you driving a Kia? And for me, it's like, it's not that I always wanted that Range Rover. That was my dream car one day. But I didn't want to buy it when I didn't have any investments. I didn't know how long I was going to play in the NFL. So what I did is I stayed humble. I stayed in that Kia and I was saving money. I was investing. And then I got to the point, years down the line, to where I finally bought that dream car with passive income. income coming in from other investments, and I was able to buy that car that way, and I feel like that was much more gratifying. So I challenge people to where it's like, that's my thing. I wanted that car one day. Maybe your thing is just vacationing. Maybe your thing is traveling. I'm not saying you can't have it, but being intentional about when and how you reach it. And I always challenge people to add one thing into that equation. Instead of making money and then just spending it, make money, invest it, and then start to spend when that investment starts to become fruitful. So now you're spending off of passive income, off of the growth of your net worth, and not off of your earned income. So when you can do some of the leisure things you want in your life based off of passive income and based off of your investments growing, that's a real flex. Not just, oh, I made $50,000, I'm going to spend it on this vacation. Invest that first, and then as it becomes fruitful, then start to spend on those things. And I think that's a more realistic way of looking at it than the messaging to where it's like, live frugal forever, or you don't have to do that, or and like some people might be okay with that, but I come across a lot of people who's like, so you're telling me I can never buy the car that I like or take the kind of vacation that I want to take. I don't want to make people live in a limited mindset, but I do think delayed gratification is important.
I love that. Completely agree. And when your money can work for you that you've invested to be able to obtain those things, it's even more satisfying. So, Devon, we've been able to get so much information and wise knowledge from you, but I bet there's even more in the book that you have coming out. So, could you give us an explanation of your book and some of the information in it?
My book is going to be called Real Estate Side Hustle. It comes out October 15th, so about a month away. I'm super excited. Bigger Pockets is my publisher, so I've been working hand in hand with them, and I'm super excited about it. It's for working professionals who have day jobs and they're trying to learn how to invest. And we talk about a lot of the concepts we talked about today. I pretty much break that down, and I feel like it's something, regardless of where your income level is today, there's things you're going to be able to take from it because it starts with the mindset. We talk a lot about that spread, about the investment vehicles, and how to invest passively while having a day job and a career. So it's something I'm super passionate about. I want to help more people figure out how to generate income and build wealth while they're having a day job. And I hope everybody can go pre-order it today, and you'll get all the bonus content as well.
Yes, we'll have all the links below. And Devon, any parting words, pieces of advice, or things you may say to the newbie who really wants to get into investing, but needs a little bit of a push to understand how?
I think my recommendation for that person is earn the right to take risk. And what I mean by that is do the work. You're listening to this podcast, so you're already starting to do the work. You're listening to podcasts and stuff, but now you're earning that right to be able to take risk in your first investment. So don't be afraid to shoot your shot once you've earned the right. There's some people out there who don't understand the basics. If you don't know what a cash on cash return is, if you don't know what loan to value is, take the time to read the books, to listen to these type of podcasts, to get a good general knowledge. But then when you've gotten that knowledge, take your first shot, take a shot. And it doesn't have to be a home run. It could be a base hit. That's perfectly fine. Just get on base and watch where it takes you. So that's my biggest recommendation. I see so many people, they either don't earn the right or they earn the right, but then are scared to shoot their shot. So those two go hand in hand. Earn the right, then take your shot, and be okay with the base hit when you start out. And I think 10 years down the line, you're not going to be mad at yourself for going with the base hit. You're going to thank yourself.
Excellent piece of advice. Thank you so much, Devon. We will be pre ordering your book. Again, links below. And also for those that want to follow you on social media, how would they do so?
Just at Devon Kennard across all social platforms, you'll be able to find me. And my website is devonkennard.com, so can find me there as well.
Great. Thanks so much, Devon.
Thanks for having me. It was a pleasure.